We are in a financial crisis. I know a lot of people don't want to believe that we are in a financial crisis, but we are. And how do I know it? It's because the banks are starting to fail. I mean, if you think about it, 2008, they called it a financial crisis, but it really was a bank crisis. And banks are failing because as interest rates increase, which they're continuing to increase, they're actually going to cause more pain for basically financial markets. Now, I know that the mainstream media, they're basically saying, well, it's an isolated incident, it's just these two banks, and that's not really something to worry about. But here's the thing, the Federal Reserve is going to be continuing to raise the rates. And what's weird, though, is the markets don't really believe it. Jerome Powell has been actually pretty clear about there's no rate cuts in that you can expect, and he expects to raise it another quarter and then to keep the rates at that level for about a year, or so, I think 7 months to a year. But what's weird is that the financial markets are actually discounting that. They're saying that they don't think that that he's going to keep the rates that high, that he's not going to raise it any further, and not only that, but they're pricing in rate cuts this year. Isn't that crazy, Danny?
Rates are going to need to come up more to deal with the inflation, because inflation is still too high.
Yeah, inflation is high, and interest rates, they need to be higher than the rate of inflation. So with the next CPI report, I think that's going to influence the Fed quite a bit, because they're going to be very data dependent, as they like to keep telling us. But the problem is that there's a big difference between what the markets are saying they think is going to happen and what Jerome Powell and the Fed say is going to happen. So the problem with this is that people are still way too optimistic when there's absolutely no reason to be optimistic. For one thing, markets think there'll be rate cuts. What happens when that doesn't happen? It seems like the markets will have a big tantrum when they're going to be disappointed, because it's actually inconceivable at this stage that they don't believe Jerome Powell. They think that he's joking around for some reason, and that he's not really going to keep the rates this high. I think they really underestimate him. Maybe they just think that there's no possible way that he would do what he said he's going to do, and there's really no reason to doubt him at this point. Now, the other thing is that PE ratios, they're still pretty high historically. So it's not like if you buy right now, you're buying stocks cheap. So I think there is an issue of that valuations are still extremely high. What are you actually buying? You're buying PE at some of the very high valuations. So it's not as though if you buy right now, you're definitely getting a good deal. That's definitely not the case. We have not seen capitulation at this point in time. Haven't really seen extreme sell signals. Corporate earnings are likely to go down because as the interest rates are continuing to go up, it's really starting to hurt companies. There's more money that has to go towards fulfilling debt, and we're starting to see commercial real estate definitely have a lot of pain, because the truth is they can't really afford these extremely high rates. And so it makes you think that something is going to absolutely fail at some point, just from the huge costs that are involved in terms of keeping things afloat when everything is becoming more and more expensive. So how can I really actually struggle to imagine some of these people, maybe they're bored of waiting out of the market because they just really are itching to buy. But I think that's the sad thing about bear markets, is that for a while there's a period of time in a bear market where you get a little bit bored, because it is boring to some extent to be in cash and say, haha, I'm not invested in it, I'm gonna just wait it out and watch the market decline. But at some point you get a little itchy, you're like, oh well, I waited out enough time, I want to get back in. And the sad truth is, sometimes the last stage of the bear market is one of the worst, because that's where the big drops happen, and that's where the real significant fear takes place. And just there really is no reason to have a big position in stocks at this point in time. And if you think about it, tech has been hurt a lot because the way tech works is that when interest rates are low, people are willing to bet on the future. Oh, well, these companies are not that profitable, but I'm willing to pay a very high PE because it'll be profitable later on, and besides, they will borrow money really cheaply and invest it in stocks. But as rates go up, other investment ideas seem like they're a better idea, and that's one reason why people tend to take money out of the markets and put it into safer investments. In fact, we're at a crazy point in time where even bank accounts seem like a risky venture. A lot of people have been pulling money out of bank accounts because the truth is the rates they're paying is pretty low compared to treasuries, especially like weekly treasuries. So the problem with this is that as these rates have gone up, it's causing a lot of pain because it's changing behavior. It's causing people to move money from things that are risky to things that have a lot less risk, or to pay more money considering the investment ideas that are available out there. The Wall Street, of course, always wants you to think that things are a lot more stable than they really are. They want you to think that the big banks are safe, but the truth is all of these banks actually have some of the same risks that existed with Silicon Valley Bank. They all borrow money on the long-term basis, but then the money that is coming in, the deposits, are on the short-term basis. So that kind of mismatch actually creates a problem because at some point in time, people may decide at any point in time to pull all of their money all at once, which is the traditional bank run. Is it actually possible to create an anti-fragile bank where there would not be any bank runs? There actually is. Someone actually came up with an idea of it. The banks would take deposits, and with those deposits, they would actually invest in weekly treasuries. So there would be a much stronger connection between the deposits and the money being lent out. Now, they could actually charge a fee from people borrowing money from the bank, and that would be pretty much how they actually make their money. And then there could be other banks, the banks that are kind of more what we're used to, where they take deposits and then they lend it out. And what those banks could do is provide you with a little bit of risk, but you would get a higher rate on your deposits. So I think in the future it would be interesting if we move more towards an anti-fragile banking system where people don't want to take risks, they would actually invest in these anti-fragile banks. And if they want to take a little risk, then they could invest or put their money as a deposit into banks where they lend it out. And maybe more of it will be shared with the depositors than the current system. Anyway, I hope I helped enlighten you about the nature of this current banking crisis that kind of exists at the moment. It's a pretty big crisis, even though people don't seem to realize it at the moment. But it's going to become more and more noticeable that these high rates are basically creating a new crisis that cannot be avoided. Anyway, see you in the next video. Click like, and I'll see you in the next video.
My personal feeling is we're going to see less of the big tech doing well in the next bull run, and we're going to see a lot of the cyclicals and commodities probably improving a lot more. We're going to have probably higher interest rates for a lot longer than people think. So I think that the energy companies probably will be outperforming for a while. And I think that over time, people are going to get very upset about the NASDAQ performance because they probably are not going to be doing so well. And also, crypto might have a difficult time for quite some time still. I think it's still a crypto winter, and higher for longer on the interest rates are not going to be very conducive for seeing the crypto doing very well, but we'll see. But other than that, I think we're going to see some new lows probably this year. We're going to see new lows on S&P, and Also, you want to probably sell. There might be a rally into the next rate hike. If it's the last one, that might be the time to sell. So other than that, it's going to be good to just hold a lot of cash for a while.